Hey, Odie's on Finance. This is Dr. Aaron Neufeld, one of your co-founders. Before we get started with the event, just want to make sure that you guys all jump on the website, odiesonfinance.com. Make sure to sign up for the newsletter. Use all the resources, including our recommended resources and our student loan refi. Also, make sure to jump on the Instagram, follow that as well. Now, today's event was a little bit different than the ones we've had before. We had some technical difficulties live streaming the event from Zoom to Facebook, and so we ended up jumping on to BeLive, which was our backup streaming software. Unfortunately, with BeLive, only our guests could be live streamed. So the way this event worked is I was actually texting questions and texting prompts to our guests. Fortunately, he also had an outline of questions that I was going to ask him during the interview, so he was kind of going off of that. And then the other thing is, he's great at just ad-libbing and going on his own pace, so it actually worked out pretty well. But just a quick introduction if you're not familiar, our guest today was Mr. Peter Schiff, and Peter is an economist. He's got his own radio show called The Peter Schiff Show. He's been a guest on a lot of different productions, such as the Joe Rogan podcast, CNBC, Bloomberg News, and Fox News. So he's kind of this widely regarded economist. He's definitely got some contrarian views to what we teach on Odie's on Finance, but it's always good to have these contrarian views. It's always good to see what others have as opinions. So without further ado, we're just going to jump right into the live event. You're only going to hear Peter talking because, once again, I was just feeding him text. So
I'm going to talk a little bit. I guess this is a group of ophthalmologists or optometrists. Not really sure, how long you guys have been in the business, whether you're still paying off your student loans, or whether you actually have built up, a net worth through operating a practice, whether you're self-employed or whether you're working for somebody else. But to the extent that you have financial assets and you have an investment portfolio, I think it's very important that you do something to not only protect yourself from what is about to happen over the coming months and years, but to profit from these unfortunate events. It's long overdue. We've been kicking the can down the road for many, many years. And as a result, the problems have really built up to a point that's, far greater than what I originally was concerned about years and years ago when I first started to warn about the day of reckoning that was coming. But to really kind of understand, how we got into this terrible situation, you really, just go back to Alan Greenspan and his early tenure as Fed chairman. He started in 1987, just before the October 87 stock market crash. And Greenspan began, and he basically was the longest serving Fed chairman ever. And he began that long tenure by making a mistake following the 87 stock market crash by, adding liquidity, creating money, and trying to prop the stock market back up. He was worried that the stock market coming down would, cause a recession, that there would be a reverse wealth effect associated with falling stock prices. And he was trying to mitigate that. And so he artificially lowered interest rates to prop up the stock market. And he basically prevented a recession or pushed it off a bit. But that was the first of many, many mistakes that Alan Greenspan made, where every time something went wrong and it looked like the economy might have been going into a recession or the stock market was going to go down, he would intervene. And it really culminated in the dot-com bubble, which peaked out in March of 2000. And when that bubble finally popped, we had a recession associated with the unwinding of those excesses. Now, the problem was the recession wasn't actually deep enough. The recession wasn't allowed to run to its natural conclusion because Greenspan intervened and artificially stimulated the economy with more cheap money. This time, Greenspan brought interest rates all the way down to 1%, which at the time was the lowest they had been. And he reflated the stock market, but more importantly, he added a lot of air to the real estate bubble, which had already been inflating in the few years before 2000, but then it really took off when the Fed slashed rates to 1%, and we had this housing bubble, and that really distorted the economy. And you know what people don't get is that we need recessions. Recessions are the market's way of fixing the mistakes that are made during the artificial booms that the Fed creates by keeping interest rates artificially low. We get too much debt, too much speculation, not enough savings, economic imbalances build up to the point where the market tries to correct it, get rid of the bad debt, reset asset prices, and create a more stable foundation from which, you know, a real economic recovery can be built. But we never get to do that. We have, you know, a heroin addict. Every time the heroin addict starts coming down from his high, the Fed just injects them with more heroin, only every time it's a bigger dose. And so we had a bigger dose in 2001 when the dot-com bubble popped. And then when the housing bubble popped, which was much bigger than the bubble we had in the 90s, well, now the Fed needed even more monetary heroin to try to truncate an even bigger recession. That one was the worst recession since the Great Depression. And I had forecast that. I wrote a book in 2005, Crash Proof, How to Profit from the Coming Economic Collapse. That was published in January of 2007. And everything that happened in 2008 was predicted in that book, including what the Fed did in response, which was, again, to repeat its mistakes. But instead of lowering interest rates to 1%, they lowered them all the way down to 0. And instead of leaving them at 1% for a year and a half, they left them at 0 for 7-8 years. And instead of normalizing interest rates too slowly, it took the Fed about 18 months to go from 1% back up to 5. Instead, it took the Fed 3 years to go from 0 to 2. And then they stopped at 2.5, and now we're back at 0. Because what happened is by lowering interest rates to 0 and leaving them there for so long, they inflated the mother of all bubbles, a bubble in everything, a bubble in stocks, a bubble in bonds, a bubble in real estate, you name it, it bubbled up because of the most unprecedented easy money policy in the history of the Fed. And that bubble started to deflate in the fourth quarter of 2018. That's when the Fed was forced to reverse course on rates, go back to cutting rates, and abandoned its feigned attempt to normalize interest rates and shrink its balance sheet. And the Fed went back to QE. Now, they didn't call it QE. They said it's not QE, but of course it was QE because it was exactly the same as QE. They went into the repo market and printed money to buy up treasuries to artificially suppress interest rates that started to rise in early 2019. And the Fed could not allow rates to rise because we have so much debt that if rates went up, everybody would be broke and nobody could service the debt. But of course, that's what we need. We have an excess amount of debt. Debt needs to go into default. There's too much of it. It can't be serviced. It's like, an anchor weighing down the economy. People borrowed too much in the past, so they can't continue to invest in the future or spend because they're dragging all this debt that the Fed encouraged everybody to take on. When you keep interest rates artificially low, you are enticing people to borrow money that might otherwise not have borrowed it had interest rates been higher. You're also discouraging people from saving because when you don't get an interest rate, why save? So the Fed is punishing savers and rewarding debtors and speculators. And so we get more debt and consumption and speculation and less real savings and investment. So we get larger trade deficits. We get these big budget deficits. We get these huge economic imbalances. And we built up some massive imbalances that began to unwind at the end of 2018. And so the Fed quickly reversed course. Then we got COVID-19, which was like this giant, missile that hit a bubble that had already been pricked by a smaller pin. And so now there's this gaping hole and the air comes rushing out. And what is the Fed doing now? Well, it's doing exactly what it did in 2008 or 2001. It's trying to reflate these bubbles with massive, unprecedented money printing. The Fed has already printed more money since COVID-19 than it did in all of the years in the aftermath of the 2008 financial crisis. QE4 is already larger than QE1, 2, and 3 combined. And it's doing that much more damage to the underlying structure of the economy. In fact, I knew this was coming. I said from the beginning, from before the Fed even ended QE3, that QE4 would be bigger than 1, 2, and 3 combined. I said from the beginning that the Fed could never normalize interest rates and never shrink its balance sheet. I mean, I knew that, right? Everything the Fed has done, I knew. Going back to the bursting of the dot-com bubble, I saw the housing bubble from its infancy. I wrote about it. I warned about it. I helped set up a fund to short the subprime market. It was actually the top performing of all the hedge funds in 2007. It wasn't as well known. It wasn't as big, but the returns were the top. But I saw all this stuff coming. I understand all the mistakes the Fed has made in the past and the mistakes that they continue to make in the present. The problem is all of the other pundits or money managers who didn't understand what the Fed was doing wrong in the 90s, right? And didn't understand what the Fed did wrong in the early 2000s. That's why so many people were surprised by the '08 financial crisis. I wasn't surprised. I had been waiting for it for years. I wrote a book about it, saying it was coming. They started calling me Dr. Doom on CNBC when I started going on in 2004 because I kept warning about the housing bubble and the financial crisis that was going to ensue when it popped. I was talking about banks failing, about Fannie and Freddie going bankrupt. People didn't believe me because they didn't understand the problem. They still don't understand the problem. They think the Fed cured it. They didn't. They made it worse. They made the patients sicker with their phony cures. And so by the time COVID came along, the economy was so sick, right, that the virus basically killed it. If we had a healthy economy, see, that's what people don't get. See, Donald Trump wants to pretend that we had a great economy before COVID. We didn't. We had a horrible economy. We had a bubble, right? And it was the biggest bubble ever. And that's why we can't go back to where we were before COVID, because we can't reflate that bubble. It doesn't even matter at this point. They could cure COVID tomorrow. The damage is already done, right? The bubble has already popped, and all the debt has already been added to the economy. But if we actually had a healthy economy that had a lot of savings, we could have weathered that storm. The problem is we had no savings. We had no rainy day fund, and then it poured. Companies had no savings. In fact, they were loaded up with debt. Individual households have no savings. They're living paycheck to paycheck. So the minute they lost their paychecks because their business had to shut down, that's it. They're done. They can't pay their rent. They can't make their car payments. They can't pay their student loans. You know, everybody is living in this debt bubble, and this whole thing is unraveling. And so in order to try to prevent this massive collapse, the Fed is now printing money to replace all the income that everybody lost. The Fed is bailing out everybody now. It's not just the TARP where they're bailing out banks. They're bailing out everybody who borrowed money from the banks. They're bailing out the auto companies. They're bailing out the airlines, the hotels, all these small businesses. They're writing checks to everybody who's unemployed. In fact, they're paying people, in some cases, twice as much not to work as they used to earn when they worked. Where's all the money coming from? The Fed is printing it. It's never printed like this. 60 cents out of every dollar the federal government is spending is being printed into existence by the Fed. The Fed is printing more money than the government collects in taxes. This is unprecedented. The debt to GDP now, if you count state and local governments, is now 150% of GDP. And it's rising like crazy. The budget deficit of this year is like $3 or $4 trillion. And this is under Republicans. Wait till the Democrats take over in 2021. So this is this massive inflation tax. People think we get all this government for free. It's not free. It's very expensive. Every dime the federal government spends has to be paid for by the public one way or another. The government doesn't have any resources. It only has the resources that it takes from the private sector. So right now, the government is spending all this money and it's not collecting the taxes. So what's it doing? It's printing the money. But that doesn't mean we get the government for free. The government is taking purchasing power away from the people who have it and giving it to people who don't. So when the government taxes you to give somebody money, they take your money and they give it to somebody else. So now the other person spends it and you don't have it. But if they just print the money and give it to somebody else, you still lose because now prices go up. The other person that gets the money now bids up prices. So you end up buying less stuff because your money is less valuable. So that's where we're headed now. What's coming now is not going to be just a financial crisis like we had in 2008. This is going to be a dollar crisis and a sovereign debt crisis where it's U.S. treasuries that nobody wants to own, not just mortgages. This is much, much bigger. 2008 was kind of like the dress rehearsal for the main event that's about to happen. And so this is what people need to be prepared for. Now, I see there's some questions, member questions. What do you think the remedy for hyperinflation? Well, look, I mean, hyperinflation, I haven't gotten to that, right? Because here's where we are now, right? The Federal Reserve is creating all this inflation in order to prevent asset prices from falling, in order to prevent companies from going into bankruptcy, in order to prevent all these foreclosures. Look, if the Federal Reserve did the right thing, we would have the worst economic downturn in the history of the country because that's how high we are. That's how many mistakes have been made because the Fed kept interest rates so low for so long. I mean, the reason the Fed doesn't want to do the right thing is because it's scared out of its mind to do the right thing because it realizes how painful doing the right thing is. So what it wants to do is postpone that pain by kicking the can down the road, right? But every time they kick the can down the road, the problem gets worse, right? And so now, where it's just so horrific. But what's going to happen is, as the Fed is printing all this money to buy up all these assets so the prices don't fall and to keep people spending, the dollar is going to crack. The bottom's going to fall the dollar. And then prices are really going to start to rise, right? The Fed now pretends that there's no inflation, which is all a bunch of BS because inflation is the expansion of the money supply. The effect of inflation is that prices are higher than they would have been if there was no inflation. But the way we measure consumer prices is flawed. The government's yardstick is deliberately designed not to capture all the inflation, at least the way it manifests itself in prices. But as bad as that ruler is, the inflation is going to be so bad and the effect on prices so great that even the government's ruler is going to show that inflation is pretty high. I mean, well above the 2% that they consider acceptable, or well above 5%, maybe even above 10%. And so at some point then, the Fed is going to be forced to choose between two very, very unpleasant choices, right? The first one is to stop the inflation, to finally do something about it. Now, because they waited so long and they let it get so bad, they have to really let interest rates go up. Now, in 1980, in order to break the back of inflation in the 70s, interest rates went up to 20%. I think that this inflation will be so bad, so much worse than the 70s, that it may require an interest rate well above 20%. But the reality is we have so much more debt now than we had in 1980 that even if rates went to 5%, it would be a catastrophe, let alone 20%. So if the Fed decides to fight inflation, it has to shrink its balance sheet sell bonds, all the bonds it's been buying, treasuries, mortgages, muni bonds, junk bonds. It's got to start dumping that stuff on the market. It's got to shrink this money supply, let interest rates go up. Everything's going to crash. All the big banks that we bailed out in 2008, every one of them is going to fail. And none of them can be bailed out. They all have to fail. And not only will shareholders lose money, not only will bondholders lose money, but the depositors of these banks will lose money because the FDIC has no money. And if the Fed is contracting the money supply, then the Fed can't bail out the FDIC. So everybody gets wiped out, everything crashes, and the government has to fess up and tell the American public, you can't get your Social Security because we don't have the money, right? We can't sell these bonds because the Fed doesn't want to buy them. The trust funds have nothing. We can't pay pensions to our retired workers, right? It's an actual bankruptcy. That's one choice that the Fed has. And that's the better choice. That's the better economic outcome. But unfortunately, they're probably going to pick what's behind door number 2. They're not going to select that one because politically it's a no-win, right? It's certain death for the politicians if they choose that door. So they choose the other door. And that's the one that leads to hyperinflation. See, that's the one where they're like, oh, forget, no, there's no way we could do this. We can't fight this inflation. We can't force this austerity on the country. So we're just going to keep printing money. We're just going to buy up everything. We're going to buy all the bonds that nobody wants. We're just going to print all this money. And then they destroy the dollar, right? And that's worse. See, not getting your money is bad. But getting your money, but not being able to buy anything with it, that's worse. You know, I mean, if we had a default on the bonds, but if we told our creditors, hey, we owe you all this money, we can't pay, but we'll give you 25 cents on the dollar. So if you have $100,000 worth of treasuries, we'll actually give you $25,000. Okay, at least you get some money back. But what if the Fed doesn't do that? They give you your entire $100,000 back, but that's not even enough money to buy a pack of chewing gum. What do you have? You don't have anything. You know, we are headed for a massive monetary crisis. There's no way around this. So it's inevitable. I don't know if we're going to have hyperinflation or we're going to dodge that bullet. But even if we do, what we're going to have is going to be really, really bad. We're going to have massive inflation. Even if the dollar survives, it's going to survive at a fraction of its current valuation. Maybe it's going to lose 70 or 80% of its value. Now, that's better than losing 99% of its value, which it could do in hyperinflation. But even 78% of its value means prices go up 400, 500%. So something that costs $20 today costs $100, right? And that's going to mean a big difference because people's standard of living is going to go down. You know, what I think is going to happen here is at the end of this, the U.S. dollar is not going to be the reserve currency anymore. And that is a big deal. You see, before Bretton Woods, before the U.S. dollar became the reserve currency, there was no reserve currency. The reserve for all currencies was gold. All the paper currencies were backed by gold. Now, the U.S. government made a deal with the world. We said, hey, what are you guys doing holding all this gold? You're not getting any interest on your gold. Why don't you hold U.S. dollars instead of gold? You could take those dollars and buy U.S. treasuries and get 5-6% interest on that. And the dollar's as good as gold. We got your gold here in Fort Knox. Whenever you want your gold, just ask for it. We'll send it to you. Every $35 you have, you're entitled to 1 ounce of gold. That's our promise, right? That's the commitment we made. It was an IOU. Dollars were like an IOU for gold. In fact, the dollars were the gold. The paper was a promise to pay dollars that were a weight of gold. And so the world believed us. We suckered them, you know, and once we got them, you know, when we printed a lot of money in the 1960s, not by today's standards, but by the standards that existed back then, and we didn't have enough gold. And we ended up going off the gold standard. And the dollar tanked. Gold went from $35 an ounce to $850. The Swiss franc went from 23 cents to 75 cents. You used to be able to buy 360 yen for the dollar in 1970. By 1980, you could buy 150, right? You used to get 4 Deutschmarks to the dollar in 1970. By 1980, you can only get 1.5. So the dollar went down, but it continued to function as the reserve currency. What's going to happen this time is it's not going to be the U.S. going off the gold standard. It's going to be the world going off the dollar standard and returning to the gold standard, because you can't back your currency with another currency that's backed by nothing. You need to back your currency by something, and that something is going to be gold. One of the reasons the price of gold is going up, and it's going much, much higher, because the world can't go back on a gold standard with $2,000 gold, not unless we deflate all the other prices. The only way to do it with our current price structure is for have gold maybe 15 or 20,000. Then it'll work. Doesn't work at 2,000, right? There's too much money out there. And so unless they want to have massive deflation, which they don't want, gold price has to be revalued up for the world to go back on a gold standard. And that's what's going to happen. But that is the end of the gravy train for the United States of America. Because the minute we no longer print the reserve currency, now we got to start working again. We got to start producing. If we want to consume, we got to produce. If we want to import, we got to export. We just can't print money and get stuff. We've been printing money and sending all this money out to the world that cost us nothing to make, and they ship us all their stuff. That costs a lot. All the resources needing to produce stuff. You don't need anything to create money. It's just out of thin air. So we have this phony economy based on debt and consumption and consumer spending. That whole thing implodes. We have to start go back to basics. We need to build factories again. We need to train people how to work in factories. How are we going to do all that? We got all these people that have philosophy degrees. How are they going to make something? You know, and meanwhile, they got, you know, all this debt because they took these ridiculous, worthless college courses. So this whole economy is going to have to restructure. It's going to be terrible. And politically, it's a big disaster because, you know, socialism is really reared its head. This massive economic catastrophe is going to be blamed on capitalism, just like they blamed the '08 financial crisis on capitalism. It had nothing to do with capitalism. Capitalism would have prevented the crisis. Government caused it, the Federal Reserve. The Federal Reserve has got nothing to do with capitalism. That's a central government planning of money. They price fix. The Federal Reserve is like the old Politburo. They're fixing the price of money, interest. That's in a capitalist economy, you don't have that. The market sets interest rates, not the government. You don't have somebody just picking interest rates. That leads to a disaster. That's why we just go from bubble to bubble, because we don't have capitalism. We have this socialism when it comes to our monetary policy, and it's wreaking havoc with the economy. But this crisis is it. I mean, it's coming, and you only have one chance to get it right. If you get it wrong, you're done. I mean, people that missed the dot-com bubble, they didn't know that was a bubble. If you just held on, the Fed saved you. The market came back. If you didn't realize the financial crisis was coming, if you didn't realize the housing bubble was going to pop, if you just held on, the Fed bailed you out again. They can't do it this time because the money they're printing is going to collapse in value, and they can't bail you out with worthless money. So you've got to bail yourself out in advance. You got to recognize that it's not going to be the third time's the charm when it comes to the Fed bailing out investors who are blindsided by bubbles. It's going to be 3 strikes and you're out. So that's, you know, what I would suggest that the people on this phone call do. I mean, obviously, if you just have student loans, don't worry about that. Inflation is going to wipe those loans out. So just don't even, I mean, the best thing you can do is don't pay, don't make payments, take advantage of the forbearance, because eventually the inflation is going to wipe out the debt anyway. But if you have assets, see, here's the thing. Inflation wipes out debt, but it also wipes out the creditors who own that debt. So it's great. Inflation is going to be a good thing for debtors that have no assets and just owe money because, you know, they're out of jail. Although the economic environment is going to be terrible. So it's not like it's going to be all sunshine and lollipops for people that have a bunch of debt. But at least they won't have the debt anymore. They'll have other problems to worry about. But when the debt is wiped out, the assets are wiped out because one person's liability is somebody else's asset. So your pension gets wiped out, your annuities, the cash value in your insurance policy. And in fact, the insurance companies get wiped out. So you know what happens when your house burns down? All right, well, the insurance companies have no money to help you rebuild it because they got wiped out. They had treasuries. The treasuries are worthless. The savings of the nation get destroyed. in inflation, right? So the losses are going to be huge. But if you have financial assets, what you got to do is get out of US dollars, right? Think about inflation as a tax, right? Because again, I said the government has two ways of getting money. They can take it from you in taxes, or they can print it and take your purchasing power. So they can take your money through inflation, or they can take it through taxation. Inflation is a tax that we can avoid by not owning dollars, because inflation is a tax on dollars. So get out of dollars. Don't own what they're taxing. So one thing you do is you buy gold. Gold's going much higher. Buy silver. Silver's going much, much higher. Right? Silver was at $50 in 2011. It's about $27 now. I think it's going to several $100s an ounce at a minimum. But you can buy it. You can buy gold. I have a company, Schiff Gold. Schiffgold.com is a website. You can go there. You can buy some physical gold and silver. Don't let someone talk you into buying numismatics, collectibles, rare coins. You don't need any of that crap. You're not a coin collector, right? You don't want to collect stuff. You want to preserve your wealth by buying bullion, right? As cheap as you want to buy coins and bars as close to the spot price as you can, so you get as much gold and silver for your money, right? So you should do that. Maybe have 5 to 10% at a minimum of your net worth in real money. That's what I look at it. But your stock portfolios, you got an IRA. You could roll over to me to manage for you, pension account or just an individual account. You own stocks, fine. Get rid of U.S. stocks. U.S. stocks aren't as bad as U.S. bonds. U.S. bonds are going to get wiped out. So you don't want to have any money in dollar-denominated bonds. No muni bonds, no corporate bonds, no treasuries, no CDs, nothing. Because that's what gets hit the hardest by inflation. But even U.S. companies are going to get hard hit, corporations. And of course, when the Democrats take over, they probably will, they're going to force U.S. corporations to prioritize their workers, not their shareholders. They're going to turn corporate America into like a social experiment. They're going to raise taxes through the roof, and they're going to pile on all these regulations that are going to make our businesses far less competitive than they are now. So they're just going to get clobbered too. It's going to be a massive bear market, worse than the 1970s. But what I'm doing for my clients, and I've already done it for myself, is I'm investing in equities in other countries, in Switzerland, in Singapore, New Zealand, Australia, Hong Kong, Norway, different countries where I think that the economies are going to weather this better, that their currencies will hold on to more of their value. They're not going to have hyperinflation. They have better macroeconomic fundamentals, better balance of trade. Their budget, their government debt is low relative to GDP. They rank higher. Most of the countries I'm investing in rank higher in economic freedom than the United States, because where you have freedom, you have prosperity. The less government you have, the more freedom you have, the more prosperity you have, the better it is to be an investor. The only friend investors have in America is the Fed, and that's just an illusion. You don't want to put your faith in a bubble. You want to invest in reality, because all bubbles pop, and then all the phony wealth evaporates. I want real wealth, so I'm investing in countries that are generating it, not generating bubbles. And we're buying a lot of gold stocks. I mean, gold stocks are going to kill it. I think if you want to own stocks that can go up 10x, 20x, maybe even 50 or 100x, the gold stocks, gold and silver mining stocks, that's where you're going to get it. I manage some portfolios of gold stocks. I also own and manage. I have a manager that works for me. Guy's name is Adrian Day. But we manage a portfolio of gold stocks directly, and my gold fund, mutual fund. Now you can have an account with me, or you could buy any of my funds. You could buy my gold fund. You could buy my international value fund, my international dividend payers fund, my emerging market fund, or my foreign bond fund. All those funds, Europe Pacific funds, you can find those at Schwab, Fidelity, Ameritrade, E-Trade. All these discount brokers have my funds. You could just buy them there. But you can also have an account with me, talk to my reps at Europe Pacific Capital, and we can buy the funds for you, and we can build you portfolios. If you have a large enough account, you can save money by not having to pay all the fees that would be associated with being in a public fund. We can manage an account, a separate account for you, with individual securities in them. We trade all around the world. So we have funds that focus just on mining stocks and more funds that are for value or dividend paying. See, the key is to invest in these foreign stocks that are not only denominated in foreign currencies, but they earn revenue outside the US in those foreign currencies that I believe are going to appreciate. And then they're going to pay you dividends in those foreign currencies. So as US dollar is collapsing and as the cost of living is going through the roof in America, for you it's not, because you've got an income source that is rising as the dollar is falling. So from your perspective, prices aren't going up because your income is going up relatively the same or maybe faster. Maybe even prices are going down for you as they're going up for your neighbors. So you got to get these portfolios set up. So my website, it's Euro-Pacific Capital, Europac.com, EUROPAC.com is the website, and you can get the 800 number there. You can fill out some information, get one of my brokers to call you and talk to you about our strategies and how to get the account set up. You can have a brokerage account and kind of work with a broker on your own and buy stocks, or what I prefer is you just set up an account for me to manage, either in individual stocks or in my mutual funds. I have a wrap program where I manage a portfolio of my funds. So we manage the funds and then we manage the portfolio of my funds. But they are all designed to do well in an environment where the U.S. economy is in trouble. We're in recession, inflation. It's stagflation really is what's coming, not just inflation and recession, but the combination of the two, which we had in the 1970s. Excuse me. But it's going to be much worse. I mean, because the U.S. economy is in much worse shape now than it was going into the 70s. I mean, it's night and day. I mean, in 1970, America was still the world's biggest creditor nation. We still had the largest trade surpluses in the world. I mean, we're the opposite. We're the mirror image of what we used to be. We're the world's biggest debtor. The economy's a basket case now, thanks to all these decades of artificially low interest rates and bubble blowing and hollowing out our industry, and all the things that we used to make, we now import because we don't have a real economy anymore. We have a financially engineered bubble. All right. And so this is going to be a rude awakening. It's going to be a major, economic catastrophe for the nation, but you can try to mitigate the damage to yourself. I mean, I've taken more drastic action. I moved to Puerto Rico because I know that taxes are going way up and I don't want to pay them. But there's two big taxes. It's income taxes that are going way up, but the inflation tax is going to go up even more. And in fact, it's a double whammy because inflation makes asset prices go up, even if real values of those assets go down. Let's say the cost of living goes up tenfold, but your assets only triple. You're way behind. But when you sell those assets, the government says, hey, you got a capital gains. You got to pay tax on that gain, but you don't have a gain at all. You actually have a loss. You have more dollars, but those dollars buy less. So you actually have less stuff. So inflation creates a secondary windfall for the government. Not only does it wipe out their debt because the government is the world's biggest debtor, but it enables them to collect more taxes because it creates gains out of losses. And then you pay taxes on them. So you got the inflation tax, you got the income tax, capital gains tax, and you got the two working together to tax the hell out of you. So, I mean, you could look into moving to Puerto Rico if you want to run a business out of there to get out of the income tax. But the inflation tax is easier to avoid. You got to get out of dollars. You got to own these foreign assets. The good thing about owning dividend-paying foreign assets is you never have to sell them. So you won't have to pay that capital gains tax. You'll just keep collecting your dividends. And your dividends will keep going higher and higher and higher. Now, they can tax your dividends, and they will tax your dividends, but at least they can't get your principal, right? Because your principal is, they'd have to seize it. They'd have to physically seize it, which, I wouldn't put it past them. Who knows what they may do, later in this crisis as things get worse and worse. The government has a tendency to do a lot of illegal things when times are bad. But, we can't even really necessarily think about that now. What we got to do is, take the actions that we can. We can protect our wealth from inflation now, given the current regulatory environment and tax system, by getting out of U.S. financial assets, getting into foreign assets, getting into emerging markets, which I think represent tremendous opportunities because they're going to really benefit from the decline in dollar, the collapse rather, not just like a decline, a collapse of the dollar, because they have a lot of dollar debt, which will basically be forgiven. And that's just going to be a giant weight lifted from the backs of their economy. Now, I'm looking at this window over here. I mean, does anybody want to type some questions in that I can answer while, while I'm online and you guys are there? But you'd have to type something into that window. Also, people, you see that little sign over there, Schiff Report. That's my YouTube channel. I do my own podcast. If anybody doesn't know about it, you should go and listen regularly. Listen to every podcast I do at schiffradio.com. I usually do a couple a week, sometimes more. You can also listen to them on my YouTube channel, the Schiff Report. But you know what? Start listening to the older ones. I mean, I've been doing it for years and years and years. So, I mean, if you want to see how much stuff I've gotten right and how many things that have happened that I predicted would happen, go listen to the old podcast. Now, there are things that I said would happen that haven't happened yet. And there are people that say, oh, see, he's just a stop clock. Look, all these predictions are going to come true. I can't tell you exactly how long it's going to take. I just know what's going to happen. No, it's hard to know exactly when it's going to happen. It's hard enough that to know what's going to happen, let alone to be able to put a precise date on it. But, the problem is the government and the Federal Reserve have been able to postpone the consequences of these problems. But as I said earlier, the trade-off is you postpone the consequences by making the consequences worse. But that's always a trade-off that the politicians are willing to make, because then they're making something worse for the next guy. They're not going to be in office. They're going to be gone, right? So they don't care about making the problem worse as long as it's somebody else's problem. Now, of course, if they cared about America, if they were patriots, then it would be their problem and they would give a damn. But they don't. They're very selfish, these politicians. They just care about themselves. They just want to look good, and they don't care how much real damage they inflict on posterity in order to do it. But, a lot of people keep saying, the debt, we're piling these debts on our kids, our grandkids. This is the generation. The people that are listening to me right now, you are going to pay for all the profligacy of the past. You are the kids that people were talking about in the 1960s and the 1970s that were going to get left to bill. This is it. The buck stops with us. Right? We're going to deal with it, not our kids or our grandkids now. And so to mitigate the damage that you feel personally is you got to, again, get out of U.S. assets. All right, so now I'm seeing a couple of questions. Guys asking me, what do you think of gold royalty streaming companies? I love them. We own a lot of these companies in our funds and in our managed accounts. Streaming companies, the beauty of a streaming company is you don't have any of the costs of production, right? What these companies do is they loan money to mining companies and they get paid back as a royalty on their production. So they get money for every ounce of gold that they produce. Now, the great thing too about these streaming companies is as the price of gold goes up, right, that royalty is more valuable because now, you're getting a percentage of the gold. Well, if gold is at $2,000 an ounce, your percentage is twice as valuable as when it's at 1,000. So automatically the streaming companies are more valuable as the gold price goes up. But the other kicker is that as the gold price goes up, mines produce more gold because you have gold that maybe is uneconomical to mine. Let's say you have a gold mine and the price of gold is $1,200 an ounce. And you have some gold that you can mine for $900 an ounce, but you have other gold that costs $1,400 an ounce. Well, you don't mine the $1,400 an ounce gold because you'd lose $200 an ounce. You only mine the $900 an ounce cost. So now if you have the royalty, you're only getting a royalty on the gold that costs $900 an ounce to get out of the ground. But the minute the price of gold is $1,500 or $2,000, now the mines could start mining their higher priced gold. So now as the production goes up, the guy with the royalty, now I get a bigger check. So these things are going to be cash machines. There's not that many of them. There's only a few of these companies, good ones. And you have them in silver as well as gold. In fact, I just invested in a company, it's pre-IPO, they're going to be a royalty company. They had a royalty on zinc and copper. So I think it's a great business to be in because, inflation makes costs go up also. So when you have the royalty, you don't care about the cost so much because you're not paying that. You're just getting a royalty off the top. But we have those in my mutual fund. But I think some of the biggest gainers are going to be some of the smaller companies, the junior miners, and those are the ones that you want to hire an expert like Adrian Day, my guy. He's been doing this 30 or 40 years. I wouldn't do it myself because chances are you can end up buying nothing. There's a lot of landmines, as well as gold mines. So literally. So you got to know which ones to avoid as well as, which ones to buy. Anybody can buy the big major companies, right? You could just buy the Newmonts and the Franco-Nevadas, which that's the biggest royalty company, or, the Agnico Eagles or, whatever. Those you could buy, Barrick Gold, But if you want to buy the smaller companies, the lesser known companies, then let a professional do it for you and manage the portfolio. That's what we're doing. And my gold fund is doing fantastic. All my funds now, have kicked in. This year they're doing fantastic in this environment that we have now. And I think this is the beginning of a major, major bull market in commodities, precious metals, emerging market, foreign stocks, probably the biggest bull market we've seen relative to the U.S. market. Much bigger than the first decade. From 2001 to 2011, U.S. markets were the worst performing markets. You did much better off in foreign markets, emerging markets, commodities, energy, agriculture, precious metals, everything crushed it. U.S. market was a disaster. This decade, it's going to be an even bigger disaster. So you got to avoid that. But more importantly, you got to participate in these profits that I think were going to be enormous outside the United States. Are there any other questions? What countries are the best? Look, as I say, we invest in a lot of different countries. I mentioned a few of them earlier, but in general, we try to find companies that have less countries rather than have less government, fewer regulations, lower taxes. I also invest in some countries that I think are particularly well positioned to benefit from a commodity boom. And so some of those countries may have more regulations, but I think their economies are going to just so benefit from this strength in commodities that I want to have exposure to those areas. But you don't have to worry about that. If you're letting me manage the money for you, you're buying my funds. We're doing all that for you. We're doing the research. We're picking the markets. We're picking the stocks for you, and we're trading them for you. You don't have to do any of that. I take all the worry out of it and make it simple. What is a reasonable target ratio for someone looking to convert silver to gold? I wouldn't be converting silver to gold just yet because I think silver is still cheap relative to gold. You're better off going the other way around, converting gold to silver at the current ratio, even though it's not on the lows. I think, silver's got a ways to go before I would start selling silver to buy more gold. Right now, it's more like I'd still be selling some gold to buy silver. Although the best time to do that was March, April, May. I was pounding the table on that on my podcast. I kept telling people, call up Schiff Gold and use some of your gold to buy silver because silver was the cheapest it had ever been in the history of the world, right? At least in recorded history, you were able to buy 120 ounces of silver for a single ounce of gold. That had never happened before. So it was a great opportunity. Silver was on sale. A sale like we've never seen. So the prices are not that cheap now. It's above 70 to 1. Silver had a pretty big comeback. Silver, you could have bought. In fact, I bought some silver myself from Schiff Gold. I bought some silver coins to have in the house when in Puerto Rico, when the COVID hit. I paid under $13 an ounce for my silver delivered to my door. It got up to almost $30 an ounce last week. Almost a triple just in silver coins. But I think they're going a lot higher. From here. Thoughts on cryptocurrency? Look, cryptocurrency is just a speculative game. It's not an investment, speculation. It's not gold. It's not digital gold. Bitcoin is fool's gold. It's got nothing in common with gold. Yes, they try to pretend it was gold. They make it look gold. When they try to depict Bitcoin, they make a gold coin with a B in it. But there's no coin. It's just a string of numbers. That's all it is. Computer generated numbers. It's got no substance. You can't do anything with it like actual gold. And, gold's a store of value. Bitcoin's not a store of value because you can't store what you don't have. Gold stores value because I can do something with gold. I can make something with it. I can make jewelry out of it. I can conduct electricity with it. They have gold in all the cell phones, all the computer chips. There's real demand for gold. And why gold's a store of value is I can take a gold coin and in 10 years, in 100 years, you can melt it down and it's just as good as if I melted it down today. And in fact, any gold that had been melted down, you can take it and bring it back into a coin. Even when you use the gold, it doesn't lose any of its properties that it had originally. I mean, it's a fantastic metal. It never corrodes. It never tarnishes. Nothing happens to it. And it has all these other properties, as far as ductility and malleability. It's fantastic. The most useful metal that exists on the planet. And none of those properties decay over time. So it's the ultimate store of value. Bitcoin can't be used for anything, so you don't store anything. You buy Bitcoin because you think somebody else is going to buy it at a higher price. And they're buying it because they think somebody else is going to buy it at a higher price. But the minute you run out of suckers, that's it. The Ponzi scheme is over, a pyramid collapses, and that's it. So, it's like, who knows when the music's going to stop? I think that Bitcoin peaked out at 20,000. I don't think it's going back up there. Maybe it will. Maybe the bubble's going to get bigger. I don't know. I tend to think it already maxed out. We'll see. But regardless, I think it's going to collapse. So I think people are going to end up losing a lot of money in Bitcoin and all the other cryptocurrencies. So just avoid them. There's just no point in playing around. You can get into real money, gold and silver, mining stocks. There's so much more upside potential with legitimate investments that you don't need to fool around with these fiat cryptocurrency pyramid schemes. You see, what should one do if you have a large sum of money in the S&P in your retirement account? Sell, get out, but you got to get out of dollars too. You can't just get out of U.S. stocks. You got to get out of dollars. So if you have a retirement account, if it's self-directed, transfer it over to my firm. I'll manage it for you. We'll get you out of the S&P 500. I mean, first of all, the index is dominated by a bunch of massively overpriced stocks. You got a very narrow set of stocks, half a dozen stocks, maybe a little more, that are like 20, 25% of that index. Those stocks can go down 50, 75% almost in a heartbeat. So, but, it's not just the money that you lose in the stock. It's the money that you don't lose is going to lose value. Let's say you lose half your money. The half that you didn't lose will lose 80% of its value. So you're going to get decimated in U.S. stocks. So you got to get out. But, you could lose even more money in U.S. bonds. So, but it's just about investing abroad. That's what I would do. I mean, I don't have any money. I personally own some S&P 500 stuff. Like I own Newmont Mining. Newmont Mining is the only gold stock in the S&P 500. So I own that. I also own a few oil stocks in the U.S. They're not my favorite oil stocks, but I own some U.S. oil stocks that are in the S&P 500. I'm very bullish on oil. So, but most of my oil stocks are outside the U.S. Most of them are European oil companies. There are better values there. Let me see. Thoughts for first-time home buyers. You're not going to make any money as a homeowner. You may make money as a debtor, right? Because inflation is going to wipe out your debt. But the real value of your house is going to go down, right? So if you're going to buy a house, though, make sure to have a mortgage because that's your shot at making some money because you're going to screw the guy that loaned it to you. He's going to be the loser, whoever owns that mortgage. Of course, the taxpayer is on the hook for a lot of these. I'm not against buying a house for that reason. If you can have a long 30-year fixed rate mortgage on the thing, sub 4% mortgage. I mean, it's pretty cheap money. The money's going to get a hell of a lot cheaper. So you find a nice place and you think you're going to live there. But I think that in terms of gold, I think U.S. real estate could go down 80, 90% or more. So, in real terms, real estate prices are going to get hit. They're going to get hit very hard, but so are all prices, not just real estate prices. But because of the debt, it may not really cost you anything to buy the property. If you borrow almost all the money, you didn't really put anything down, so you really got nothing to lose, except your mortgage payments, which inflation will wipe out. So, and obviously there, markets are different. I mean, some property markets are not nearly as overpriced as others. And COVID is changing a lot of things. Like a lot of people are moving out of the cities now. There's a lot less reasons to live in the cities because you can't do anything because everything is closed. You don't want to get COVID. Your kids are stuck at home and they got no place to go. So people want more space. They're working from home. So what the hell do you need to be in a city for? And the crime is going through the roof. It's only going to get worse. The cops are afraid to arrest anybody. So you got more crime. You got COVID. You got people not having to go to work because they can work from home. So people don't want to be in the cities anymore. They want to be further away. So, I mean, you've got these trends that are obviously going to impact the market. And the commercial market's going to get decimated because, people don't need office space anymore. People don't need as many stores. People are shopping online. The restaurants don't have any business. The gyms, the salons. I mean, all this stuff is imploding. This has been a bubble that's been inflating for a long time. And in fact, even before COVID, these brick and mortar companies were having a hard time compete with Amazon. I mean, now it's even harder to compete. So that's it. I mean, they're done. Last question. I know it's late for you. Am I shorting anything? Well, I'm short the dollar, right? And everything I'm doing, it really is being short the dollar. And just being long gold is really like being short the dollar. I mean, but I'm not shorting individual stocks. And this is the reason I'm not doing that. When you short a stock, you're long the money that you get from selling the stock. So I sell a stock to get cash. But the Fed is printing all this money. What if they print so much money that the money loses value or more value than the stock that I've shorted? Then the stock can go up and I lose because the stock lost less value than the money that I got by shorting it. See, when you're shorting stocks, you're really fighting the Fed, right? Because the Fed is doing everything it can to prevent stock prices from falling. Now, if the Fed wasn't doing this, if the Fed was going to say, hey, we're just going to get out of this money printing business. We're going to let the market set interest rates. We're going to let the market set stock prices. Yeah, I'd short stocks. They'd crash. I might not even have a time to short them. The minute the Fed announced that they were going to let the free market work, stocks would crash, right? But the reason they're not crashing is the Fed is not letting the free market work. The Fed is doing everything it can to prop up the stock market, and it's willing to sacrifice the dollar to do it. So rather than shorting stocks, I want to short the dollar. I want to short what the Fed is sacrificing to save stocks. I don't want to fight the Fed. I want to profit from what the Fed is doing. And that's what I'm doing, right? And I think I'm going to make a lot more money, even if stocks go down. I mean, what's the most they're going to go down? They're going to go to zero. So I short a stock at 100 and it goes to zero. I make that 100. What if I buy a gold stock at 10 and it goes to 100? I make 10 times my money, right? Rather than double my money. I mean, so I think there's a lot more upside in buying what's going to go up because the Fed won't let the stock market go down than shorting stocks in case they decide to let the stock market go down. And even if they don't decide to let it go down, it may go down anyway. But I still think the upside potential in the stuff that I'm buying is better than the upside potential in the stuff that I'd be shorting if I was going to be a short seller. But that's not what I'm doing. And I think my strategy is going to ultimately make more sense. But I mean, look, there's a lot of stocks that seem to be crying to be shorted. And there's a whole graveyard full of people that have been shorting them. Now, eventually, some of these people are going to be resurrected from those graves. But I mean, there's a lot of pain. There's that old saying that the markets can stay irrational longer than you can stay solvent. So I don't want to deal with that. I'm not on leverage. I'm not shorting. I'm just buying what I know is going to go up because I know the dollar is going to go down. And that's already started. The dollar is already fallen, but it's a long way down. And at some point, it's going to become a crash. The dollar is going to fall through the floor. And when that happens, everything I own is going through the roof. And so before that happens, you guys that are listening to me, you need to get your portfolios positioned in a way that's similar to mine. All right, yeah, I wish this thing would have worked out a little bit better technologically. I'm not really sure what the problems were, but if everybody is hearing me, that's that's fine. But don't forget, contact my office. Talk to one of the brokers at Euro Pacific Capital about your account and the type of accounts we can offer you. Whether or not my strategy is suitable for you. You got to make sure, and you got to pick. I have many different strategies, ways to incorporate foreign stocks, foreign bonds, precious metals into your portfolios. And so, yeah, talk to my representatives. I mean, some of you may be able to talk to me depending on the size of the account. Contact my guys at Schiff Gold about getting some physical gold and silver. And again, follow me on social media. I'm on. You guys are on Facebook now. I'm there on Facebook, Peter Schiff. I forget how many people are friended me on Facebook, but I forget what I got, 100, 200,000. I mean, I got more. I got about 280,000 Twitter followers. So you can follow me on Twitter, Peter Schiff. I'm not verified. They refuse to verify me, but I'm the only Peter Schiff with 280,000 followers. My YouTube channel, I have about 300 and almost 360,000 subscribers to my YouTube channel. So it's a Schiff Report. Subscribe to that. And make sure, also, I just started on Instagram. I've only been on Instagram for less than a month. I've got about 45,000 followers there. So that's kind of my smallest platform. But I've got all those followers in just a few weeks. So that's not bad. But it's Peter Schiff is my Instagram handle. So follow me on all those sites. Tell your friends, get them to follow me. I mean, I really try to put out as much information as I can to educate as many people as I can so they understand not only what's going to happen, but why it's going to happen. And so they know who to blame. They don't blame capitalism or the free market or anything, that they blame government, central planners, central bankers. That's who's causing these problems. And the only solutions lie in the free market. There is no government program to solve this problem. Every government program will make the problems that government programs caused even worse. We need to eradicate these programs, repeal these rules and regulations, and allow free market capitalism to function. That's the only real salvation. But I want to get that message out there, and I want to save as many people as I can financially. I want as many Americans to avoid going broke. I mean, there's going to be so many broke Americans. We need to make sure that we're not all broke. Some of us have to have money outside the U.S. so that we can repatriate it. Otherwise, the whole country, to the extent that we still have capitalism left, the whole country is going to be owned by foreigners. Some Americans have to retain some wealth, and we can only do that by getting it out of the U.S. now so that we can repatriate it later, when the dust settles. But anyway, yeah, so that's it. Thanks, everybody, for listening, and I look forward to working with some of you, in the very near future as clients of Euro Pacific Capital, Euro Pacific Asset Management. Thanks.